All right, so we're going to go to our next presentation, Financial Freedom for Firefighters. Brad Lineberger is a former firefighter who made the transition from firefighting into financial planning. As president and founder of Seasign Wealth Management, Brad is proud to run a comprehensive wealth management firm that helps firefighters smoothly transition into retirement. He's familiar with unique challenges that firefighters face in planning for their retirement and enjoys crafting tailored solutions to help them accomplish their goals. After graduating from UCLA in the late 90s, Brad was turned off by the sales culture of Wall Street and simply wanted to help people and make an impact in the community. He discovered the fire service and spent 11 years as a firefighter serving the communities of Chula Vista and Orange County. He has a heart for helping firefighters make good financial decisions that provide peace of mind in retirement. Brad, a third-generation California, lives in Carlsbad with his wife Vanessa and their four children, Luke, Jake, Rebecca, and Catherine. In his free time, Brad can be found spending time coaching his children's teams, surfing the Cardiff Reef, or being outdoors with his family. Let's welcome Brad.
All right. Hey. Thank you. All right, so are you kidding me right now? I got to be the. Sorry. Yeah. Thank you. Thank you. Thanks for having me. I got to be the guy that follows Mr. T. You're joking, right? If I knew that I was following Mr. T, there's no way I would have said yes to this. I'm going to kill you, Phil. Oh God. All right. So look, I'll try to make there's no way we can be as good as Mr. T, but we'll try to make this as good as possible. So let's talk about what we're going to go over today. And before I jump in, I should just say why I'm here. He mentioned that I was going to go into Wall Street out of college, and that sales culture was so lame. And if you guys remember the movie Wall Street, not the Wolf of Wall Street, not the one with Leonardo DiCaprio, it was the one before, Michael Douglas, Charlie Sheen, those guys. Those interviews felt exactly like that. Greed is good and money never sleeps and stuff. It was awful. So a good buddy of mine, Chad Gremmel, he's a chief now, he says, hey, you got to check out the fire service. And I did, and I did everything you needed to do, and ended up spending 11 or 12 years serving Chula Vista and then Orange County Fire. And it was just an awesome, awesome career. But I started doing financial stuff, mostly for the guys and gals, as a C-shift job. And it got to the point where, I was part of a team and then ended up doing more and more of it and launched a company. And my wife goes, hey, you got to pick one of these things because we don't ever see you. So I ended up sticking with the one that kept me home at night with the family. But I miss the job a lot, and I miss this, I miss the camaraderie, I miss the guys, I miss sitting around the coffee table, hearing the stories of the stuff that the guys do. You literally can't make this stuff up. So thanks for having me out today. My goal is to, I've walked in your shoes before. My goal is to share with you how to be financially successful from the vantage point of being a firefighter too. So here we go. We're going to talk about investments, deferred comp, required minimum distributions. We're going to talk about things that you want to think about if you're earlier in your career, if you're mid-stage career, and if you're transitioning into retirement. And we can talk about some things if you already are retired as well. We're going to talk about how to avoid the biggest mistakes, and we're going to touch on taxes and see if we can help you keep that tax bill a little bit lower. So that's what we're going to cover today. We'll move through a lot of stuff, and I think all of you understand the concept of what we're trying to do when we invest. We want to create compound interest. I think Einstein said it's the 8th wonder of the world. And that's just the process of investing your money early and letting it grow so your money starts to make money for itself. And I think we all understand these concepts, but I'm going to break it down a little bit for you today and help you apply this to what you're doing with your finances too. And so when it comes to deferred comp, a lot of questions that I get asked, people go, hey, should I invest before tax or should I go after tax to my Roth? And if you're still working, this applies to you. If you're no longer working, if you're retired, now for most of you, your money is pre-tax which means you're going to be faced with large tax bills as you take money out of there. So by a show of hands, could you just tell me, who do we have that say 10 years or less on the job today? 10 years or less? All right, somewhere between 10 and 20 years? 10 and 20, 20 plus? And then retirees. Okay, thanks for that. I can definitely gear this a bit more towards that. So, what's that? Okay, so we'll help for most of you who are mid-stage to later stage or even retired. Most of your money is pre-tax, meaning every dollar you take out of there is going to hit your tax return and it's going to be taxable. For anybody that is earlier in your career, I think there's a real strong case that you guys can make to consider using the Roth 457 or Roth IRAs. Anytime you hear the word Roth, it means you pay taxes in the year that you earn it. All of it grows tax-free, and you take money out tax-free. Why I think that for early to mid-career folks is because I think tax rates are going up in the future. I think we're in a low tax rate environment now. I think taxes are going to go up. And if you have any sort of pension, and most of us do, you're going to have a tax bill already coming from that. So taking the money out tax-free is going to be really nice. All right, so if you want to talk to me about that later, I'll stick around and we'll touch on that. But for most folks, the decision might be too late already. But for all of us, it's important that we understand how to invest successfully. And I just see so many mistakes, and I'll touch upon that later. But there's three fundamental truths to successful investing that most people get wrong. You might get one or two of these things right, but it's rare that I see people get all three of these fundamental truths correct. And in order to illustrate this, I'm going to pick on this colorful box. We call this the Skittles chart. And all these boxes represent different asset classes or places that you could invest your money. Stocks, bonds, cash, real estate, commodities, those kinds of things, okay? Crypto today, whatever. So all these boxes are different asset classes. I'm gonna pick on this yellow box right here. This is the emerging markets. And this is a time period, I know it's hard to see, but it's the late 90s, so 1999 through 2013. And I'm picking on this time period for a reason, and it's because if you look at the blue box, this is the S&P 500. We all know how hot the S&P 500 has been for the last 10 years. It's compounded at more than 5% above its compound average. It's been like 15% per year for the last decade, out of this world. But in this particular 14-year period, right after the dot-com boom and bust, and then the mortgage meltdown of 2007 through 9, the S&P 500 compounded at less than half of its long-term average. So people that put all of their money in the S&P in the late 90s and started taking money out of there in retirement, those folks went back to work in about 2016 because they ran out of money, okay? But these fundamental truths are gonna help you avoid that type of scenario and set you up for success. And the first one is that risk and return are related, meaning if you don't want to take any risk, you're not going to get any return. But there's good risk and bad risk, and we're going to talk about that right now. So the yellow box is the emerging markets. And this is, what if you put your money in the emerging markets for 14 years and let it ride? And the compound return after 14 years was about 11% per year. So you quadrupled your money. You put 100 grand in and it turned into $400,000 in 14 years. A fantastic ride. But I'm going to show you in a minute why you would have hated the ride, and most people didn't get those good returns because of how rough the experience was. So in 1999, you loved it. You're up 66.5%, only to hate it the next year. You're down 31, you're down 2.6, and then the unthinkable happens. You lose money for a third year in a row. It's losing money. Most people, what do? They sell, they get out. And then of course they miss out on 55, 25, 34, 32, 39%. It goes on a run. What did they do right there in '07? They buy. Why do they buy? Well, their father-in-law is making a killing at it, their neighbor, their fireman buddy, everybody's making a killing at this thing, and then they get hammered. They're down 53% the next year. This is the person that sells, they lock in the losses. They're walking around today. We all hear it. Oh, investing doesn't work. It's broken. It's gambling. It's like, it's rigged. Only the rich are making money. It's like going to Vegas. Bullcrap. It's not, it clearly works. It's our behavior to the way that it works. That's what's broken, and that's what I'm here to help you fix. So if you locked in your losses there, you missed out on 78, 18, down 18, up 18, down 2.6, a very wild ride for this wonderful result of quadrupling your money, and that's why most people simply didn't do it. So risk and return are related, and the second fundamental truth that we've all heard, but I'm going to break it down for you, diversification is so important. That's how you harness the long-term returns correctly. And we all know, don't put all your eggs in one basket, but now I'm going to pick on a second box here, the gray box, which is REITs, or real estate. It stands for Real Estate Investment Trusts. So I'm going to show you what happens. Let's say you put half your money in emerging markets, half in real estate. You still quadrupled your money after 14 years. A great ride. But watch how the experience gets smoothed out. In '99, half your money's in first place. The other half is in dead last. But combined, you're somewhere in the middle. And the next year, first goes to worst, and worst goes to first. And again, you're somewhere in the middle. The next year, a positive and a negative. So you start to notice that the ride starts to smooth out as you introduce these additional asset classes. And then the third fundamental truth to investing, look at this. You cannot time it. Look at the colors. There's no pattern. There's no predictability to this. People ask me all the time, hey, what do you think the future holds? And I can give you my opinions, but most of them are going to be wrong. No one would have thought this year, after the S&P 500 had compounded at 15.25% per year, that with the tariffs, with the trade wars, the S&Ps going down, nobody would have predicted that international investments would be outperforming the S&P, but that's exactly what's happening. International large, international small, and emerging markets are all outperforming the S&P. You cannot predict this stuff. You can't try and time it. I've heard people all the time try. You simply can't. And I've studied them all. Believe me, I've tried. I've studied them all. And usually people get it right. You got to get it right twice. When do you get out and when do you get back in? Most people can get it right once. They sometimes can call the top on valuations. It's really hard, though, to get back in at the bottom because things feel so scary. It feels very dark. You just can't do it. I see people get it right usually one of the two times, and then you follow along to see if they have some sort of track record that they develop of doing it right. They don't. People make a killing, making these big claims, hey, I called the top here, there, and there, but they just don't do it consistently, right? But what can you do? You can introduce an asset class that behaves opposite the rest, and that is illustrated by this orange box. It's short-term, high-quality bonds tend to behave opposite stocks. Now, that's not always the case, but for the last 200 years, for the most part, when stocks are going down, the short-term, high-quality bonds are going up. I don't love bonds, but that is the asset class that, again, will help you smooth out that ride. So then what you need to figure out, depending on where you're at in your life stage and your investing career, is what's the right mix of stocks to bonds to cash to real estate. And it's going to be unique to everybody, but I can help you think those things through. But I wanted to share with you the 3 fundamental truths to investing. Most people get this stuff wrong, but that's where you cannot time the market. You've got to put your money into the right asset classes to set yourself up for the long haul. And let's talk about diversification. So here, this is updated data, so you know that I'm not cherry picking the data. This is the end of 2024, and there is the S&P 500 compounding at 15.25% per year. There's real estate now in second place, international small in third place over the decade at 9.5% per year, international developed at 9.35, US small, emerging markets, there's commodities, and then bonds and cash down here. But I want to draw your attention now to the white box. So the white box is a mix of 70% stocks, 30% bonds. And again, this is not a recommendation. If you're retired, this might look and feel appropriate for you. If you're earlier or mid-career, you don't want any bonds. Depending upon your situation, even retirees may want less in bonds as well. But it's to illustrate a point that I want you to look at where the white box is every year. You follow along here, and that white box, 70% stocks, 30% bonds, is never once in first place. It's also never once in last place. It's always somewhere in the middle, and it achieved about an 8.2% return for a pretty moderate portfolio over 10 years. And so again, depending on your situation, maybe you're going to be more aggressive than that. That means that your highs are a little bit higher, but your lows are a little bit lower, and your long-term returns would be 1 or 2 clicks up, a little bit better. Or maybe you're more conservative, you're older, you're in retirement, and you don't want to be this aggressive. Then your highs wouldn't be so high, your lows wouldn't be so low. You'd still get decent long-term returns, but it would just be a click or 2 less. And so that's the way to properly set up your investment portfolio, is figuring out how many years you have until you need to start taking money out of there. That's really what drives this decision, okay? And so the key, one of the mistakes I see people make is they don't have any or enough international investments in their portfolio. And this is just to share with you the market cap, so the publicly traded companies around the world. You can see that, yes, 61% of publicly traded companies are located here in the US. And we love the US market. We think this is the best market. It's the most efficient marketplace. The companies here are just fantastic. However, you don't want to put all of your money in the US alone. You still want exposure to international developed. You get the point. There's 40% of available options are located outside of the United States. So the question for you is, the first question you got to ask is, how much of your portfolio should you have in stocks versus bonds? And that's going to be a function of when do you need to take money out of the portfolio. If you're taking money out now, or if you're taking money out in the next 5 years, anything that you're taking out in 5 years, you want to be careful about the stock market, because it's anybody's guess in a 5-year period. So if you're taking money out, you wouldn't want to have everything in stocks because it's too volatile. But then the second question you got to ask is how much to have in the United States and how much to invest internationally, spread between international developed, international small, and emerging markets. So typically, if you were to just do it straight world market cap, you'd put 60% of your stocks in the US and 40% international. But here's the reality. If you did that, which is an academically justifiable move, you would have suffered the last 10 years. Because you just saw on the slide before, S&P 500 killed it, 15.25% for 10 years, okay? But the 10 years before that, you would have loved it because international did well. So the decision is up to you. I would recommend considering 25 to 30% of your portfolio international. Again, I think you could make a case to go all the way up to 40, but just you're setting yourself up for these long periods of time when you are looking, and the hardest part about it is the behavior part. You're looking at the S&P 500 and it's killing it, and then you're looking at your international investments and you're fair to Midland, and I just see people get so tempted to ditch the international investments, load up on the S&P, and if you did that, you're underwater. You're down money this year. Meanwhile, the international investments are up. So this is a really big decision for you guys to make. Most of you in your deferred comps have an international investment piece. One of the things that you got to be careful with deferred comp is looking at the expense ratios of the funds that are inside of your available options. Sometimes they're high. Sometimes they're high, which basically eats into your returns. If you have money outside of deferred, like a Roth IRA, you can get, I like ETFs or index funds, but ETFs, exchange traded funds, super low cost. You can build a portfolio with these boxes that I'm showing you here very easily using index funds and ETFs. You can do it at Schwab, Vanguard, Fidelity, really low cost, and you can get good results. Okay, so this is, what we're comparing is a globally diversified mix of all stocks versus the S&P 500 over a 50-year period going back to 1970. So this includes the S&P, but also has 40% to international, like I was just talking about. This is the S&P only. And you get the idea that remaining globally diversified over the long haul is the way to go. However, you will go through these 10-year periods, and you can't time it. And sometimes it's not for straight 10 years. It might be 2 years, and then it just ebbs and flows a lot. And it's really hard to stay the course because things are shifting and changing. So that's why I say, choose how much you want to put in international, and then what you do every year is you rebalance through the market. You cannot time it, but you can have a plan, like Mr. T talked about, have a plan, and I pity the fool who doesn't have a plan. Most people don't. But have a plan, and then every year go in and sell a little bit, not all, just a little bit of the investment that's done the best. So I'll take you back. So the last 10 years, what you've been doing is you're selling S&P 500. You're trimming S&P over the last 5 years, and you're buying into emerging markets. If you've got bonds in your portfolio because you're in retirement or close to retirement, you're buying bonds, you're buying emerging markets, you're buying the things that were on sale. We all know that we should buy low and sell high. Nobody does it. Why? I'll show you why. It's because I would have been telling you, you gotta sell the S&P. You got to trim a little bit, 2%, 5%, you got to trim. And people look at me like I'm crazy, like I am a fool. You know, like why would we sell it's the hottest investment out there? Then they start to believe, well, it's a new world order. The international investments are dead. Europe sucks. It's, you know, capitalism's dead. Whatever, you know, I've heard it all. Well, I heard the same stories in March of 2009, when the S&P 500 had just lost 1% per year for 10 years. And those international investments were hot, and people said the same thing. We're gonna ditch the international, or we're gonna ditch US, right? Because it's dead, it's a dead story, the dollar's dead, the new world order, emerging markets, international, it's red hot, we're gonna load up there. And I said, no, not because my crystal ball works. It broke 20 years ago. Nobody has a crystal ball, it's broken. It's that these things ebb and flow. So anybody that sold out of the US in March of 09 after 10 years of losing money missed out on 15.25% per year for the following 10 years. And anybody who loaded up on emerging markets at that time period would have really regretted it today. And so the same story is in play right now. You don't want to be loading up on the S&P. You want to make sure that you are internationally diversified. All right, so the rebalancing aspect is key. People ask me all the time, how frequently should I rebalance? Is it every month? Is it every quarter? And there's studies that show that if you do it too much, it's not healthy. If you're doing this on your own, if you're not working with somebody, once a year, put it on the calendar for December or January, once a year and you're fine. You would be absolutely fine if you had a roadmap of, okay, this is my goal of the mix of investments that I want to have. And then once a year you went in there and sold anything that was a little bit out of balance and bought the thing that was underweight. Again, it's hard to do because it's forcing you to sell the thing that's just done the best. And emotionally, we cling to it. It's recency bias. We hang on to that. But the reality is having the discipline to stick to your plan, it's hard. It's simple, but it's not easy. Okay, got to prepare you. For most folks in the room, if your money is before tax and not in a Roth IRA, you are going to have required minimum distributions coming out at you. Depending on your birthday, there's been lots of rule changes. It's either going to be age 73 or age 75. Again, depending on your birthday. And what happens is they require you to take money out. It's based on the balance of the account at the end of the year. And whatever that balance is, there's a factor of how much they make you take out, and it comes out and it's going to hit your tax return. You're going to pay taxes on all those dollars. So the challenge is if you are aging, you're retired, you're aging, and tax rates start to go up, you lose control of that. And Uncle Sam basically forces dollars out, and you're going to be paying taxes for those dollars. So one thing you could consider to do is what's called a Roth conversion, which is the process of when you're for those of you that still have deferred comp, consider that the Roth option now. You make your you pay your taxes now. The Tax Cuts and Job Act was supposed to sunset at the end of this year. I think we're going to get 4 more years of it. So you got another 4.5 years of a lower tax rate environment, and then taxes go back to where they were in 2017, and then I believe the taxes will get adjusted and go higher because of the the deficit and where interest rates are at. They need to generate revenue, and eventually I think they're going to come after higher taxes. So those RMDs can be reduced or even avoided if you do conversions. What that means in plain English is after you retire, you take bits and pieces of your pre-tax dollars and you put them over, you convert them into Roth IRAs. And so every conversion that you do is taxable, so work with your tax professional, but the strategy is if there's ever a year where you're in the middle of a tax bracket, you can do a conversion just enough to stay in that same tax bracket but not go over it. So you can, and there's no limit on it. You can do the entire account all at once, but be careful because that could throw you into a much higher bracket. Or you could do, I prefer to do little bite-sized conversions. It can be 3,000, 5,000, 10,000. You pay the taxes as you go, and now you start to build this tax-free bucket that protects you. You're gonna really like it when you're in your 70s and 80s because it's all coming out tax-free. Couple key things to note on this. If you do conversions, I'd prefer, don't pay for taxes out of the dollars that you convert. Have cash on the sidelines. Pay your tax bill with cash. Don't use it because then you're consuming your investment account. You have less money that's compounding for you. So I like conversions, but don't use your account to pay the tax bill. Pay out of pocket. So if you're just starting out, and I know that that's not the audience in here, so I'll be really quick here, but I think Roth 457 is best for the new folks, or if you have people that you know that are earlier in their career, 100% Roth. Build that emergency fund. 3 to 6 months is ideal if you're working. Invest aggressively if you're new in your career. All stocks I'd recommend. Start saving for that down payment. All right, so I want to illustrate the concept of the Roth IRA. And again, this may not apply to you guys, but this could apply to folks that are at your stations or in your family. Let's say you did $7,000 a year into the Roth IRA, and it's compounding and growing, and let's say you're getting the long-term average of the US market of 10% per year. Now, just after 10 years, all right, you've got a little bit, 129,000. 20 years, it starts to show, all right, now we've got a little less than 500,000. But at 30 years, we've now crossed over that, you're at 1.2, almost 1.3 million, and then where it really kicks in is 40 and 50 years down the road, 3 and almost 9 million bucks. So again, this, we all may not have 50 years ahead of us, but you know people in your life that do, and this is one of those powerful things to share with them, that the compound effect of money is quite powerful the longer time frame you give it to grow and work its magic. Okay, mid-career folks. I did see some more mid-career folks out there. Hey, promote if you can. Yeah, definitely do that. Use the extra cash flow wisely, because I see it, people have it, you got a little extra coin in your pocket and you go out and you buy the bigger truck, you buy the boat, you do the better vacations. So, try to save some of that, the extra money from your promotion. Consider term life insurance, get you through at least when your kids are out the door. Get that emergency fund built, 3 to 6 months of living expenses. For college savings, anybody that's saving for college, I like the 529 plans. Again, I don't know that, so I'll stick around and we can dive into things like that later. But I think 529 plans are effective, or maybe even if it's for the grandkids. 529 plans work just like Roth IRAs. After tax dollars go in, it grows tax-free, and then money comes out for college totally tax-free. And then think about a Roth IRA for your spouse. There's going to be income limitations on this. So if she's working, he's working, whatever, you got to pay attention to the IRS rules. But Roth IRAs are really powerful. And then if you own a home, start to think about making extra payments on that home to consider getting it paid off for retirement. The question always comes up: should I pay off my mortgage before retirement, or should I have a mortgage? And I say the answer is it depends. It used to be, get that mortgage paid off. It's really nice to be debt-free. It creates financial peace to not owe anybody anything in retirement. That shifted just a little bit if you've locked in an interest rate below 3%. That happened in the right around the pandemic time. If you're sitting on a rate that's less than 3%, you can park your money at a money market fund at Charles Schwab and earn 4.2% on your money. So you're literally getting, it's arbitrage. You're using the bank's money to make money, and you could, so instead of paying extra on that mortgage, earn a little extra in a risk-free money market fund and use that to help pay down the mortgage. So that's why I say the advice has shifted just a little bit. But in general, it's a really nice feeling to get into retirement and not have a mortgage. I mean, that's a great feeling to have. But if you're on 2.5% interest, you may rethink that just a little bit. For those of you who are getting close to retirement, okay, now, and when I say close, I'd say 5 years and in, certainly 10 and in, it's kind of on the radar, but 5 and in, this is where we want to start to think about rebalancing your investments. Now, what this is going to come, the answer of what's the right mix is going to be different for everybody in this room. But it comes down to one simple thing for you. It's when do you need to take money out? So if you've set yourself up financially to where you can retire on, say, a pension or your spouse's income, or you've got enough in the bank that you're fine, maybe you don't need to take money out of your investments. So maybe you can afford to stay more aggressive for longer in your lifetime here. But let's say you know that you need to get money out. That's where you want to start to rebalance. And so I showed you an example of 70% stocks, 30% bonds. Pretty typical of a retiree these days. It used to be 60% stocks, 40% bonds. Folks are living longer. People are retiring younger, so they need to be a little bit more aggressive. But again, it's very customizable to you and your situation. But it does come down to, when do you need to take money out of the account? That's going to drive how much money should you consider taking out of stocks and putting into bonds. Make sense? Okay, and I'd say 5 years when you're, and why I say 5 years is when you start to look at the data, most 5-year periods in the stock market have been positive. But there are some 5-year periods that have been negative. Certainly if you're within 3 years of retirement, now you really want to make sure that you're rebalanced and making some adjustments, because there's been plenty of 3-year periods where stocks have been down or at least flat. Okay, so another key factor for folks as you're getting closer to retirement is that decision that you're gonna make on your pension benefit. So we all know, there's an unmodified benefit where you get paid more, then there's a modified benefit where you get paid a little bit less, but your spouse gets some. Again, it's unique to your set of circumstances here, whether you're married or not. But if you are married, just really think through and have a plan. If you opt for the higher amount, that's fine. But what happens if you pass and then your spouse has less or nothing at all? Make sure that there's a plan in place. And if you don't have the ability to account for that, then maybe you take a modified benefit, you're gonna wanna put some time into kind of road mapping your thought process on that, because that's a big decision. And I see people sometimes get it right, they don't think about it enough. And I would encourage you to spend time thinking about that. And then the question is, all right, if you go with the unmodified benefit, I know with OCFA, if there's your spouse gets something if you pass, even if you've elected, which is a really nice feature. Not every pension benefit is that way, so understand how yours works, and then consider, should you get life insurance to supplement that if you go. And sadly, I recognize, I get the notification. We lose a lot of our friends. People are dying younger and younger. So as we're talking about life expectancy and we're looking at 20 years and 40 years and that sort of thing, I recognize We all may not be fortunate enough to live that long, but if you're married, your spouse might. So that's where you do want to think about this. It may not be us that lives that long, but our spouse might. And so in many ways, it is a two-person decision. For retirees, I like to see people build up the cash reserves. When you're working, 3 to 6 months is okay. But for retirees, if you can get yourself to a year or even 2 years worth of cash, what that allows you to do is not have to rebalance to as many bonds in your investment portfolio. So in my perfect world, if I could get you to 2 years worth of cash on the sidelines out of your retirement account, that's great. Then we can be much more aggressive in your investments, and you'll see it play out over time. Bonds are good to cushion the blow, so to speak, to cushion the volatility. They don't grow so much. Stocks are for the long term where you're going to get your growth, but you might go through 3 to 5 years of being underwater or making no money. So in my perfect world, if I can get you to 2 years worth of cash for your emergency fund as you transition into retirement, that's perfect. It's just hard to do. That's a lot of money and cash. But nowadays, with money markets paying you north of 4%, it's not as painful as it was for the last 15 years. Interest rates were nothing for so long. You weren't getting paid anything. So now I think you can make a better case to try and get some money on the sideline. And then we talked about those Roth conversions, and I think the best way to do it is year by year. I like to do it in the fourth quarter when you have a good sense for what your income's going to be. Do a little tax planning in the fourth quarter. Take a look at what you think your adjusted gross income's going to be. Look at how much room you have to go until you get to the next bracket, and consider doing a small little conversion there at the end of the year. If you, and I would suspect not many of you are, but if you ever find yourself in the 12% or the 10% bracket, convert all day long. Don't hesitate, it's a no-brainer. Most of you are probably not in that bracket and never will be again. I know. If you're in the 32, 35, or 37%, that's getting on the high side. That's getting a little higher to justify. But most of us in this room are going to be 22, 24%. Maybe you're sneaking into the 32. I know we got a few chiefs in the room here. I know how that goes. But 22, 24 is a real nice gray area where you can think about, and how you want to think about it is, what's my tax situation this year? What's it going to be in 10 years? Maybe I'm taking RMDs, or maybe I'm going to be taking those a little bit longer. But 22 and 24% might be compelling. As we look back 10 years from now, you might wish that you had access to the 22 and 24, and that's really where most folks find themselves. So again, you can do small little conversions. You can start to set yourself up and build that tax-free bucket. Just don't use your investment account to pay that tax bill on the conversion. Okay, now for the fun part. So here's some of the big mistakes that I see people make, just in the trenches. People. I look at all sorts of balance sheets every week, every year, so what you're looking at right here, okay, the blue. This is the amount of time that the stock market is positive on a daily basis, and the yellow is the amount of time that the stock market is negative on a daily basis. And believe it or not, the stock market is positive only 54% of days. And 46% of all days, the market's down. So day to day, it's really a crapshoot on a day to day. When you expand the time horizon out to look at monthly, you start to see that there's more blue months. There's more positive months than negative months. And when you look at quarterly, now you really see it show up. We get more positive quarters than negative quarters. And on the annual, there's a whole lot more positive years than negative years. And so it highlights, I think it's so tempting. You're tempted, 46% of days, you are tempted to try and do something. We're all type A. We all want to as Mr. T said, you're running into the fire when most folks are running out. You want to take action. But taking action often is counterintuitive to success when it comes to investing. Let me show you the data. So this is every year going back to 1979. The blue is where the market ended up. And in most years, market's up. But now you get these little things at the bottom of every year. This shows you that every single year, the market goes down somewhere in that year. We just experienced that in the month of April, right? The market went down 10% in 2 trading days. And so this shows you that the market volatility is really, really normal and something that you just have to accept as you're investing in the stock market. Even though the market ends in positive territory, just plan on it going down something like 10%, because that's the average since 1980s, 10 to 14% in a year. That's normal, okay? That's normal. And sometimes it can be deep and it can be steep. You know, and you don't know when it's going to come and how long it's going to last. And so here's the data that 94% of all years, market's down at least 5%. 64% of the time, the market's down 10% or more. 40% of the time, the market's down 15% or more. And 26% of the time, about 1 in 4 years, the market's down 20% or more. Bear market, about 26% of the time. And so it's really tempting to want to get in and get out and try to time it. But I'm here to tell you, it cannot be done. It cannot be done. But if you try, if you swing for it and you swing and miss, the results can be detrimental. So this is a 30-year time period. S&P compounded at close to 10% per year. And the person in a 30-year period that missed the best one day in 30 years, now their returns are about 0.5% per year less over 30 years. If they missed the best 15 days, now the returns are 1.5% per year less in a 30-year period. And if they missed the best 25 days, their returns were cut in half. They blew themselves up. And I can't tell you how many times I've heard it, you know, this is going on, such and such said this, so and so did that, I'm gonna get out, I'm gonna wait for it to get better, it's gonna calm down, I'll get back in then. And the data is overwhelmingly clear. Not only can't you do it, but it's hazardous to your health if you try. And so professionals are out there, they're trying to, nobody can do this correctly, it's not worth trying. But it's really tempting. And so this is just a reminder of all the reasons we've had over the years and the decades to hit the panic button. We had the oil embargo of the 70s. We had inflation, stagflation, the Vietnam War of the 70s. We had Black Monday. The market went down 20% in October of 1987, ended up down 34% in that time period. The dot-com bubble we had punctuated right by 9/11, and then 02 was down 34%. The mortgage meltdown of 07 through 09, markets down 57%. We had COVID, markets down 34%. The bear market of 2022. There's always a reason to hit the panic button. But if you do, at any point along the journey, if you hit that panic button, you hit the eject button and you get out, look at what you missed out on over time. And I know you guys are all smart enough to where you're not doing this, but these are the mistakes that I see people make. I get asked about this every week. And I'm just here to share with you, it just can't be done. And that's one of the biggest mistakes I see people make. But this is a fantastic study that shows in this 30-year time period, again, S&P compounded at close to 10% per year. The average investor doing this on their own compounded at about half of what the S&P did, because they're getting in, getting out, they're doing the wrong things. And in the bond market, bonds compounded close to 6. Average investor is less than 0.5% per year. They're trying to time the market. They're getting cute with it. And again, you cannot do that. So this is just a reminder that over the long term, and all of us in this room, you have enough years ahead of you that some of your money should be invested for the long term to fight off inflation. That the two best asset classes, S&P 500 has done fantastic, and small companies, small cap, the Russell 2000 has outpaced even the S&P. Now it's more volatile, so you got to be careful how much you put in small cap, but a combination of US large and US small, and then international large, international small, emerging markets, and some real estate, that right there makes up your equity, the equity portion of your portfolio, and you can do this for real cheap in ETFs at some great places. Okay, so talking taxes, we've touched on taxes a bit, and I think you get the point that really I think there's a ticking tax time bomb for most of us who've put money pre-tax into our deferred comp or into our investment accounts. With tax rates heading up in the future, the Roth, any dollars in a Roth are going to be really effective down the road. But this just illustrates the point. In your investment account, if you had $1 million and you sold everything, this is in a taxable account, a non-retirement account, you'd get hit with federal taxes of 20, your state taxes another 10, and so $1 million turns into $700,000 real quick. And so it just illustrates the power of if you can get money in Roths that are totally sheltered and totally tax-free, it's going to save you a ton of money down the road. And so here's the different kinds of accounts that are out there, and I'm sure this is familiar to most everybody in the room. I've talked a lot about either Roth IRAs or Roth 457s, and so those are wonderful. We've also talked about traditional IRAs or pre-tax 457. Those are good too, just know that they come with that future tax bill. But there's two other accounts that are considered non-retirement. So if you wanted money that didn't have rules around it, because anything in a Roth, in your Roth IRA, you can't touch your Roth IRA until you're 59 and a half. Whereas on the 457s, you can access that money before 59 and a half without a penalty. So I've coached you on the importance of Roth conversions, but just make sure, have a plan and make sure you understand when you need to take money out. Because any money in your 457 you can tap into before you're 59 and a half. But once it's sitting in an IRA or a Roth IRA, you can't touch it. There's a 10% penalty, and I want to see you avoid that. So before you convert everything to that Roth IRA, just know when you need to get access to the money. And if it's before 59 and a half, you want to keep that money back inside of your deferred. But back to this, you can have a brokerage account in your name. You can have a joint account with rights of survivorship in you and your spouse's name. Or if you're married, the best way to set this up, for anyone who's married, make sure you have a living trust, and you can open up a trust investment account at any major custodian, and you can invest that way. But just understand on those non-retirement accounts, whatever you do in the account, you're gonna pay taxes on. You get a 1099 every year in February. And so there's three things you're paying taxes for. When you sell an investment at a gain, you get taxed on the gain. When you have dividends that pay, you pay taxes on the dividends. And if there's interest, like from bonds or money market accounts, you pay taxes on that. So just here's a way to be tax smart with that. Your capital gains, any gain that you sell, make sure that you've owned the investment for 1 year and a day, 12 months and a day. And so any investment you own in your non-retirement account, 1 year and a day means it's a long-term capital gain, and now it's taxed at the lower rates, which are either 0, 15, or 20%. Most of us in this room aren't going to be at 20. Most of us are going to be right around 15, which is lower than your ordinary income rate, okay? So if you're thinking about selling something, pay attention to how long you've owned it for. 1 year is your magic number. And on the dividends, dividend investing is very popular. Just understand dividends, if you have dividends, you want to make sure that a majority, not all, but a majority are considered qualified dividends, which are from big US companies. So I said a majority, not all. That goes back to diversification. So maybe 60, 70% of your dividends, you want to be big US companies. Those are qualified to be taxed at the lower tax rates, the 0, 15, and 20. Most of us going to be 15, okay? You do want to have some exposure to non-US investments, so some of your dividends, call it 30%, 40%, are going to be non-qualified, and that's just the nature of a well-diversified portfolio. But pay attention to your dividends, because you can save money on taxes there, all right? And then the ETFs I mentioned, in your taxable accounts, go with ETFs because your mutual funds that are found in the 457, and I know a lot of folks used to invest with mutual funds, they're very tax inefficient, not to mention they're expensive. So there's hidden costs, hidden fees. I have moved completely away from mutual funds. We're using ETFs. There's a line item in the tax code that allows the ETF manager to basically adjust or rebalance the ETF and not have to have you, the end user, pay the tax bill for it. For whatever reason, mutual funds haven't gotten that favorable tax treatment. So if the manager, who you're paying a lot of money to anyways, that's that hidden fee I'm talking about, the manager, as they're reconstituting the mutual fund, they pass on their activities to you, the shareholder, and you get an additional tax bill. And boy, it was awful. 2022, the market's down, and a lot of fund managers realized gains, and then you footed a tax bill in a year where your investments were down. It was rough. So I would encourage you, for your taxable accounts, move completely away from mutual funds and go into ETFs. And then here's 3 locations where you can invest and have, I think, really good outcomes. Schwab is my favorite. Vanguard is fantastic too. And then Fidelity, I don't like Fidelity as much as Schwab and Vanguard, but I find that for the folks that like Fidelity, it's like this cult-like following kind of. People are happy over there. I have nothing against Fidelity, just have had better experiences with Schwab and Vanguard. But you can't go wrong at either one of these places. You can get access to the low-cost, tax-efficient ETFs at any one of these institutions. Okay, and with that, I'm going to wrap up just a couple things. I own a financial planning firm called Seaside Wealth Management. We're located in Carlsbad, and we pump out a lot of educational information just like this. Not as long typically, like 5-minute little educational videos. We're putting out 2 or 3 a week just to coach people and educate people and just help you. So subscribe to the YouTube channel. We're doing podcasts now too, but we put out a lot of content that I think will help you over time. And there's a whole, sorry, I get out of the way. There's a whole library of information that's found there from over the years, but we just want to be a resource. I can't stand those sales-driven commission, that's why I didn't do this back in the 90s. But I just want to be here as a teacher and a coach and to help. And with that, I'm going to open it up for questions. Question?
I noticed you didn't have J.P. Morgan out there. What is your thoughts on that?
J.P. Morgan, it's interesting. You listen to Jamie Dimon as he gets older, and it's like he's unfiltered. He's not afraid to speak his mind. I kind of like that leadership style. He's like, he doesn't give a hoot, But as far as a custodian goes, J.P. Morgan is a large bank. And any one of these large banks, Merrill Lynch, B of A, they have agendas. They make proprietary products, so they make mutual funds, and their advisors they have quotas. You got to sell X amount of product to meet your quota, and they pay them more. They give them incentive trips. I mean, it's really dirty. And I'm not saying J.P. Morgan's dirty. I'm just saying that whole channel with proprietary products. I'm sure there are plenty of fantastic advisors who are J.P. Morgan advisors, certified financial planners, and the like. But I just steer clear of anybody that has a potential agenda in play. Does that make sense?
Yeah, that's a bad experience.
Yeah. So, Chief.
Most fire agencies fail to tell their employees that with your 457B plan, you can borrow against it. So listen to this real quick. If you're putting the max every year in your 457B, you're allowed to borrow up to 50% of what you personally put in at any time during your career while you're still working. So you ask yourself, where do I get the money to invest? Where can I buy real estate for rental properties and that? You borrow it right out of your 457B. So listen to this. When you borrow it, I know for Orange County Fire, it's prime interest rate plus 1%. And you pay that interest too when you pay the monthly payment on that. Yourself, it's your money. So guess what? I borrowed $50,000. I bought real estate for rental property, and when I'm paying it back, I'm putting in every year 7% more than what I'm allowed to back into my own deferred income. And so they don't tell you that, and you're good. If you did absolutely nothing other than take whatever amount you take out and stick it in a bank account and use that to pay your monthly payment back, you're still making interest on your money. But if you take that money and then invest it somewhere, that's where you get investment opportunity money to do all these cool things.
Yeah. Question.
Just sort of a comment for everybody. So all in all, what he is teaching us is this. Let me back up a step. We all work for money, right? So we've all gone out there, given the hours, the time, you get a paycheck. And then after that, what happens to the money? Most of us, maybe not know about doing this, it just sits, right? The banks make the money off of our money, right? Thought I was yelling loud enough. So he is showing all of us how once we put in that time and earn that money, now it's how to make that money work for us. And I'm telling you, this stuff will work for you while you're sleeping. He's showing us all the different avenues to do that. You just have to go in and educate yourself about it and make the moves. Don't be scared. And as he had talked about, like on his YouTube channel, he expands on a lot of this, and it's very spoon-fed on his YouTube stuff. It's just a matter of 5 or 10 minute deals, and if you want to learn more about this, and you can replay it and all of that, you're going to find out this is much easier than many others out there make this sound. And I'm telling you, if I can do it, you guys can do it. But the other thing too, how many of you guys and girls get raises every year? And if so, how much is it? A couple percent maybe here and there? Like he had said, just with the S&P average compounding and making your money work for you, you're making 10 to 11% a year. That's giving yourself your own free raise. So think about it that way, and it's with the money. It's with the money that you have already earned. And one other quick thing, the other thing he's talking about on taxes, think about this in taxes. Look at taxes about not how much you pay, it's about how much you keep. And he talked about capital gains taxes and such on that. And there's a lot of stuff out there about saying, oh, this stuff is just wired for the rich. No, it's wired for all of us. The other thing that came in, you know, the tax cut that we all saw in 2017 that's supposed to sunset this year and may go further, that is made for all of us. A lot of people put out there that's just for the rich. Baloney. It's for every tax bracket out there. So that's all I've got.
Yeah.
Thank you, Brad.
Yeah, you're welcome. Question?
Do you feel different about like a no-load mutual fund versus just a regular mutual fund?
The question was, do I feel different about a no-load mutual fund than a load? Yes, and don't get me wrong. There are some mutual funds that have that have done a good job, that still do a good job. I find though that it's difficult for the active managers to outperform the unmanaged benchmarks, especially after you take their fee out. And so what they do to try and outperform is they concentrate. They make larger bets on fewer companies. And so it's introducing some additional risk. So by and large, we've completely moved away from any sort of active manager. There's two that we'll still use in the bond space, the fixed income space, because credit quality and duration, there's still a little bit where active management can help, but it's really hard to justify that on the stock or equity side. We've gone completely to ETF. Yeah. There's some fund families that are still okay, but it's I think it introduces unnecessary risk into the portfolio. Yeah.
What are your thoughts on long-term care insurance?
Oh, great. Thoughts on long-term care insurance. So 3 out of 4 of us, so first of all, long-term care insurance is insurance that you pay for that pays a benefit if you need help with activities of daily living, bathing, eating, getting out of bed, getting your clothes on, cooking, that sort of thing. If you can't do 2 of them, 2 of the 7, then your benefit will start paying you money. And so 3 of the 4 of us, 75% of us in the room are going to need it. So we're all going to need it. Okay, we are. I mean, that's a statistic that you see out there. 75% of Americans need it, and it's surprising younger and younger ages. So if we're going to need it, my only issue with it is it's expensive. It's expensive, and then they give you these price bumps. Like every 5 to 7 years, they bump it up. So we need it. I like it. It's just, it ain't cheap. But they've made some long-term care vehicles that are that are good, that are better. And what they do, it's you pair it with a life insurance policy. So it does a couple things for you. Let's say that you pay premiums for all these years, but you never use it, because that's one of the knocks against long-term care is like, what if I don't need it? It's a waste of money, and I get that. So the life insurance will pay your beneficiary, so at least somebody's gonna get money back. And then if you need the long-term care in your life, then it starts eating into that life insurance benefit to pay you. But the other thing I really like about them now is it's a fixed payment. You enter into a contract with an insurance company and they're not gonna bump that cost up. That was my big beef with the long-term care insurance is about every 3 to 5 years it gets more expensive. So it's called a life insurance policy with a long-term care rider or benefit. It's called a hybrid long-term care policy. I love those, but you got to make sure that, have that budgeted into your financial plan. It's worth it. We're all probably going to need it. I think that's the better solution.
Thank you.
Yeah, you got it. Any other questions? All right, with that, thank you for having me out. Appreciate it. Yeah. And I'll stick around. If anybody has questions, I'll stick around and happy to help.
We're going to give you a decanter. This is for the